Alphabet stock just dropped 10%, and investors are wondering what's going on. Is this a sign of trouble, or is this a golden buying opportunity? Despite posting strong earnings, the market reacted negatively, sending shares lower. But was this reaction justified? Today we're going to break it all down and see whether Alphabet is a stock worth buying at these levels. Alphabet's latest earnings report was impressive. The company brought in $96.5 billion in revenue for the fourth quarter of 2024, marking a 12% increase year over year. Even more remarkable, earnings per share jumped 31% to $2.15. These are the kind of numbers that usually send a stock higher. But instead, Alphabet stock dropped by about 10%. So what's causing this disconnect? The sell-off seems to be fueled by two key concerns: slightly lower than expected revenue growth in Google Cloud and increased capital expenditure and depreciation. But when we dig deeper, these concerns might not be as bad as they seem. Let's talk about Google Cloud. Some headlines made it seem like the segment had a rough quarter, but in reality, Google Cloud's revenue grew by 30% year over year, bringing in a record $12 billion. That's an incredible achievement. Yes, the growth rate slowed down slightly from the previous quarter, but this kind of fluctuation is normal. Imagine an Olympic sprinter running back-to-back races. In one, they set a personal record, and in the next, they finish a fraction of a second slower. Does that mean they're losing their edge? Of course not. Over a full year, Google Cloud grew 31%, nearly doubling its contribution to Alphabet's total revenue compared to 2021. And while Google Cloud is expanding, Alphabet's core business remains strong. Both Google Search and YouTube ads posted double-digit growth, marking a significant improvement after a slower period in previous years. The second reason investors are worried is Alphabet's rising capital expenditures and depreciation costs. Higher spending can sometimes spook the market, especially when a company plans to allocate $75 billion in capex next year. But here's the key point: this spending isn't a bad thing. It's an investment in future growth. Alphabet has been increasing its capital expenditure for years, and despite that, its net income has continued to grow at nearly 10% annually. Depreciation expenses are also playing a role here. But remember, depreciation is a non-cash expense, meaning it doesn't impact Alphabet's massive $125 billion in operating cash flow. With a balance sheet as strong as Alphabet's, it has plenty of room to fund innovation while maintaining profitability. Some investors are also raising concerns about competition in AI. Companies like Microsoft, Amazon, and Meta are investing billions in artificial intelligence, and some worry that Alphabet might lose its leadership position. But here's the thing: the AI space isn't a winner-takes-all game. AI is a rapidly expanding industry, and there's plenty of market share to go around. Alphabet isn't just participating in AI, it's shaping the future of it. Demand for Alphabet's AI products is already exceeding expectations, and the company has the resources to remain a major player. So, with all this in mind, is Alphabet stock a buy after the dip? Alphabet's fundamentals remain rock solid. The company continues to dominate digital advertising. Google Cloud is expanding, and its AI ambitions are on track. Yes, there are short-term concerns, but great companies thrive by making the right investments, even when the market is skeptical. So, what do you think? Is this drop in Alphabet stock price a buying opportunity, or are you waiting for a bigger dip? Let me know in the comments below. If you're looking for the best passive income stocks and how to invest in them, then click on the video on screen right now. Thank you so much for sticking to the end. And as always, happy investing.